Thank you, Chairman Brown, and thank you very much, Ranking Member Scott, for holding this hearing. Chairman, it's great to see you again here. I appreciate your presence, and I appreciate the opportunity to talk with you about an item that I'm particularly concerned about, and that's the holistic review that Senator Britt just brought up that Vice Chair Bauer is conducting right now. It's generating a sense that higher capital requirements are on the horizon for us. And as I think about that in the context of what we've weathered, you think about the situation in 2020. It was an acute, real-life stress test, if you will. And I think that our financial system navigated that admirably. In the past, Chair Powell, you've told this committee that our financial system has proven resilient through 2020 and that the capital levels at that point in time, and I would note that those capital levels are at multi-decade highs, are in aggregate adequate. And I just wanted to follow up on those prior statements and see if you still feel that way.
So I guess I would say it to you this way. In our system, we have a vice chair for supervision who has statutory responsibilities. And when a new vice chair for supervision comes in, generally they're going to want to take a fresh look. And that's what the former one, Vice Chair Quarles did, and that's Dan Tarullo kind of had the job on an informal basis, and that's what he did. So it's only natural that someone would come in and take a fresh look, and I think that's part of the process. The role of that person is to make recommendations on regulation and supervision to the full board. The role of the board is to consider those when made, and this, to me, this just comes under that heading.
Well, as the review is underway, and I appreciate that context, one aspect of it seems to us as an apparent willingness to undo the tailoring requirements that were enacted as part of S.2155. And I understand that nothing has been finalized regarding the regulations. It's a concerning prospect if that's the case. The Fed's General Counsel just yesterday alluded to undoing 2155 by, quote, pushing down the Basel requirements on banks that were intentionally given relief in that bill. So I want to be perfectly clear that the banking regulators themselves can't just simply ignore or selectively enforce the laws. And again, I realize that the details of the study haven't been finalized or made public, but if the proposal put forth by Vice Chair Barr is either unduly aggressive or appears to contradict the spirit of S.2155, will you vote for it?
I can't answer that in the abstract, of course, but I would say we're, as an institution, very strongly committed to tailoring, and anything we do is going to reflect, tailoring of institutions according to their risk, and I mean that's a principle that we'll stick with.
I think it's quite important, again, given the legislative intent here and the concerns that we maintain that in the face of what General Counsel said just yesterday. I appreciate your perspective in terms of keeping that in place. I'd like to come with my next question, Chairman Powell, with starting the question by underscoring the importance of the independence of the Fed's monetary policy. Right now, the economic picture is about as uncertain as I can remember. We've had large companies in the private sector who are in the midst of planning layoffs and forecasting serious economic weakness in the quarters to come. Yet, on the other hand, the current economic data seems to be robust. Inflation showed some signs of softening in the past several releases. So I just hope, Chair Powell, that you could briefly tell us how you synthesize these seemingly contradictory data.
So just quickly, at the end of last year, we saw a couple of very promising, modest inflationary readings in November and December. But earlier this year, some of that improvement was revised away. In addition, we got a very strong reading on inflation in January, also a very strong jobs reading, also very strong retail sales. And so, as I pointed out in my testimony, we're looking at a reversal, really, of what we thought we were seeing to some extent, a partial reversal. It's still true. It's still the case that we're seeing progress on inflation. We're seeing goods inflation has come down significantly. There's improvement in housing inflation in the pipeline. There's not a lot of improvement yet to be seen in the largest sector, which is non-housing services. So core inflation is running at 4.7% on a 12-month basis. I think nothing about the data suggests to me that we've tightened too much. Mm-hmm. Indeed, it suggests that we still have work to do.
In that context, thinking about where the tightening goes and when it might, where and when it might happen, where do you see the terminal Fed funds rate landing in this cycle?
So we last wrote down our our assessments, individual assessments of that in December, and I think the median range was, basically people were clustered between 5 and 5.5. We're going to write down those again as part of them. We do it 4 times a year. We'll do it around the March meeting, which is on the 21st and 22nd of March. And as I indicated in my testimony, I think the data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
Got it. Thank you, Mr. Chairman.